Hi, this is Scott Brown, Chief Economist with Raymond James, and I'm here to talk a little bit about the election, in particular the mechanics behind what went on Tuesday, as well as the economic outlook, both near term and perhaps a little bit longer. When you look at the outcome here, it was a surprise, but not a shocking surprise. If you look at Nate Silver's 538 model, he had Trump with a 1 out of 3 chance of winning the presidency, and 1 out of 3 times. In fact, you would expect the outcome that we got last night. Florida and Ohio. Ohio had certainly been in Trump's camp. Florida and North Carolina were looking pretty close, flip-flopping a lot in the last few days. The big surprise here, I think, was Trump getting into Hillary's firewall states, Wisconsin, Michigan, and Pennsylvania. That seemed a bit unlikely. But as it is, it's not just the presidency that was at stake, also the Senate. And the Republicans in the Senate were playing defense this year, defending 24 seats, Democrats defending only 10. And just a couple of weeks ago, it looked likely that the Democrats would pick up 6 seats. They only need 4 to have a simple majority, and instead they only picked up 1 seat. So the Republicans now control the Senate and the House, as well as the White House. So Trump can get a lot of things done. Congress can get a lot of things done with the president's approval now. So what does this mean for the economy? Well, near term, the economy appears to have been in pretty good shape heading into this. We're seeing solid gains in the job market. We're seeing wages picking up at this point. You're seeing a lot of the benefits from low gasoline prices fading as gasoline prices stabilize. But if you get that nominal wage growth along with the overall job growth, that's very positive support for consumer spending. That's 70% of the economy. So that's likely to continue. The one area we have now is uncertainty coming out of the election. We don't know what Trump's cabinet's going to look like. We don't know how good of a relationship he's going to have with Congress. We don't know whether the Vice President, Mike Pence, is going to play a key role in the day-to-day operations. So there's a lot of uncertainties in terms of the specific economic issues that were promised during the campaign. One is infrastructure spending. That could be a little bit positive for the economy. Again, it may be a little bit difficult to get a lot of that through Congress. There may be some reluctance to spend a lot more. On the other side, we're also looking at huge tax cuts, mostly at the high end, very similar to what we saw during the early years of the Bush administration. Now, that is positive for the economy. It's not quite as positive as if those tax cuts have been pushed down into middle incomes and below, where people are more likely to spend the money. But it is probably going to be a bit of a positive. The flip side of that is you're now looking at a substantially higher budget deficit projection over the next several years. So more Treasury securities being issued. That means higher interest rates, and the bond market, at least the Treasury market, is reacting accordingly to that. We've also been seeing some weakness in the dollar as well, and that relates to the issue of trade. Now, Trump has promised to renegotiate NAFTA, a lot of these other trade agreements. That's going to be very, very difficult. The one thing the president does have control of is getting us out of these trade agreements. He can do that by himself. He doesn't need approval of Congress. And the way that process works is the president would send a letter to the individual countries involved saying that we're going to withdraw from these agreements, and 6 months later that would happen. NAFTA obviously is a big, big deal in terms of trade with Mexico. It's also a big deal in terms of companies in the U.S. that export. You think of companies like Caterpillar, Deere, Boeing. You can go down the list. I mean, these companies export a lot of machinery and goods to the rest of the world, even services to the rest of the world. And if we get an out-and-out trade war, that could be very disruptive for global trade at a time when global trade has already been slowing down over the last year. So that's a big, big concern, not just for the U.S., but the global economy as well. The economy, as we've been saying, is relatively close to full employment at this point. We do have a little bit more slack in the job market. Fed's still very likely to raise rates, we think, at this point in mid-December. Still very gradual as you look out over the next couple of years in terms of the pace of rate increases, perhaps 2 next year. I've been getting a few questions about whether Janet Yellen will resign. I don't think there's any real call for her to resign at this point as Fed chair. You could see the White House and Congress pressuring her to resign, but we think she's very likely to stay until her term ends in January 2018. So there may be some continuity there in terms of the Federal Reserve outlook. But again, looking at the Fed to gradually raise rates over the course of the next couple of years. So all in all, a lot more uncertainty. I think in the near term, you may see a little bit more caution in terms of consumer spending. People may be reluctant to increase their spending. Businesses as well may be a little bit more reluctant to invest in new capital and equipment until things clear up. So maybe a little bit bumpy in the economy over the near term, but ultimately we think we're going to prevail through this. And again, there's a lot of uncertainties further down the road as you look to what the new administration will have in store, what their priorities will be in the coming year. Thank you.